hold on to your portfolios because what just happened at the Federal Reserve has sent shockwaves through Wall Street. And if you're an investor, a homeowner, or someone with a savings account, you need to understand what this means for your money right now. The Fed just made a move that's being called a pivotal moment in this economic cycle, and the market's reaction? Well, it's been nothing short of dramatic. Let me break down exactly what's happening and why this matters more than you might think. So here's what went down. On December 18th, the Federal Reserve cut interest rates by 1/4 of a percentage point. Now, you might be thinking, okay, another rate cut. We've seen this before, right? But here's where things get interesting. This wasn't just any ordinary rate cut. This was the third consecutive reduction since September, bringing the federal funds rate down to a range of 4.25 to 4.5%. That's a full percentage point drop in just a few months. Think about that for a second. The Fed, which had kept rates at their highest levels in over 2 decades, has now reversed course completely. But wait, there's more to this story, and this is where it gets really fascinating. The market's reaction was absolutely wild. Initially, when the Fed announced the cut at 2 p.m. Eastern, stocks actually started climbing. Investors were excited. The Nasdaq was pushing toward new highs, and it looked like we were about to see another victory lap for the bulls. But then Jerome Powell, the Fed chair, started his press conference, and everything changed in an instant. The markets went from celebration mode to panic mode faster than you can say monetary policy. The Dow Jones plummeted over 1,100 points. That's a 3% drop in a single afternoon. The S&P 500 shed nearly 3% of its value, and the Nasdaq, which had been leading the charge all year with its tech stock dominance, dropped by almost 4%. Small-cap stocks? They got absolutely hammered, with the Russell 2000 index losing 4.4%. We're talking billions of dollars in market value evaporating in just a couple of hours. So what happened? Why did a rate cut, which is supposed to be good news for stocks, trigger such a massive sell-off? Here's the thing that caught everyone off guard. It wasn't the rate cut itself that spooked investors. It was what came along with it. The Fed released what's called the dot plot, which is basically a chart showing where Fed officials think interest rates are headed in the future. And this dot plot was a total curveball. Back in September, Fed officials were projecting 4 rate cuts for 2025. That's what investors were banking on, literally. But in this latest update, they slashed that projection in half. Just 2 cuts for next year. 2. That's it. Now, let me put this in perspective for you. The stock market has been absolutely on fire this year, hitting all-time highs 57 times. And a big reason for that rally was the expectation that the Fed would keep cutting rates aggressively, making borrowing cheaper for businesses, boosting corporate profits, and pushing investors into stocks instead of safer investments like bonds. But when the Fed basically said, "Hold your horses, we're going to slow this down," the entire narrative changed. Suddenly, all those lofty stock valuations that were based on easy money policies looked a lot less attractive. Jerome Powell didn't pull any punches during his press conference either. He made it crystal clear that the Fed is now in what he called a new phase of the process. They've already cut rates by a full percentage point since September, and now they're going to be much more cautious about future moves. Powell said the economy is in a really good place, which sounds positive, right? But in Fed speak, when they say things are good and they're going to slow down cuts, what they're really saying is that inflation is still a concern and they don't want to ease too much and risk prices spiraling out of control again. And here's the kicker. The Fed actually increased its inflation projections for 2025. They now expect core inflation to be running at 2.5% by the end of next year, up from their previous estimate of 2.1%. That's moving in the wrong direction if you're hoping for cheaper prices at the grocery store or the gas pump. The Fed also bumped up its economic growth forecasts, which normally would be great news, but in this context, it means the economy might be running too hot, which could keep inflation elevated and limit how much the Fed can cut rates. Let's talk about what this means for real people, not just Wall Street traders staring at screens all day. If you've got a mortgage or you're thinking about buying a house, you probably noticed that mortgage rates have actually been going up even as the Fed has been cutting its benchmark rate. Sounds backwards, doesn't it? but here's why. Mortgage rates are tied more closely to long-term treasury bonds, and those bond yields have been climbing because investors are worried about inflation and government spending. The average 30-year mortgage rate has actually increased since the Fed started cutting, which is making housing even less affordable for many Americans. If you're carrying credit card debt, you might see some relief, but don't expect miracles. Credit card rates tend to follow the Fed's moves more closely than mortgage rates, so they should drift lower gradually. But we're still talking about rates that are painfully high by historical standards. Auto loans will probably ease up a bit too, which could make that new car purchase slightly more affordable. But again, the impact is going to be modest. For savers, here's the reality check. If you've been enjoying those higher yields on your savings accounts and certificates of deposit over the past couple of years, those days are numbered. Banks are already starting to lower the rates they pay on deposits, which means your money is going to earn less over time. Money market funds, which have been paying out some pretty attractive returns, will see their yields decline as well. It's the price we pay for a Fed that's trying to stimulate the economy. Now, let's dive into something that's absolutely crucial for understanding what comes next. The Fed is walking an incredibly thin tightrope right now. On one side, they've got a labor market that's showing some cracks. Job growth has been slowing down, and the unemployment rate, while still relatively low at around 4.2%, has been creeping up. The Fed doesn't want to see unemployment spike because that would signal a recession might be brewing. On the other side, they've got inflation that's still running above their 2% target. Consumer prices are rising at about 2.7% annually, and that's making life expensive for everyday Americans. This balancing act is what economists call the dual mandate. The Fed has two main jobs: keep prices stable and maximize employment. Right now, those two goals are in tension with each other. If they cut rates too aggressively to help the job market, they risk reigniting inflation. But if they keep rates too high for too long, they could tip the economy into a recession. It's like trying to land a plane in a crosswind while juggling. One wrong move and things could go sideways fast. And then there's the wild card that nobody's really talking about enough, and that's politics. With a new presidential administration coming in, there's a ton of uncertainty about fiscal policy. Will we see big tax cuts? Massive infrastructure spending? Trade wars with tariffs that push up prices? Jerome Powell was actually asked about this during his press conference, and he was careful not to wade into political waters. He said some Fed officials are starting to factor in possible policy changes from the incoming administration, but they're being cautious because nothing is set in stone yet. This uncertainty is making the Fed's job even harder because they're trying to make decisions with incomplete information. Here's something really interesting that not enough people are paying attention to. The Fed has also been quietly shrinking its balance sheet, which is another form of tightening monetary policy. During the pandemic and the financial crisis before that, the Fed bought trillions of dollars worth of bonds to pump money into the economy. Now they're letting those bonds roll off their books without replacing them. Since June 2022, they've reduced their balance sheet by about $1.8 trillion. That's real money being sucked out of the financial system, and it puts upward pressure on interest rates even as the Fed cuts its benchmark rate. So where do we go from here? That's the billion-dollar question, literally. The market is currently pricing in maybe 1 or 2 more rate cuts over the next year, and that's it. We're probably not going back to the era of near-zero interest rates that we had after the financial crisis and during the pandemic. The Fed seems to believe that what they call the neutral rate, which is the rate that neither stimulates nor restricts the economy, is somewhere around 3%. We're currently at 4.35%, so there's probably some room to go lower, but not a lot. For stock market investors, this creates a really interesting situation. High valuations that were built on the assumption of easy money are now being questioned. Tech stocks, which have led the market higher this year on artificial intelligence hype and strong earnings, are particularly vulnerable because many of these companies don't make much profit yet and rely on future growth. When interest rates are higher, future profits are worth less in today's dollars, which puts pressure on stock prices. We saw that play out in real time after the Fed's announcement, with growth stocks getting hit the hardest. But here's the thing that's actually kind of encouraging if you look at the bigger picture. The US economy is still growing at a solid pace. Corporate earnings have been strong. The job market, while cooling, isn't collapsing. Consumer spending remains resilient. These are all signs of an economy that's functioning pretty well, all things considered. Yes, we're dealing with higher interest rates and persistent inflation, but we're not in crisis mode. The Fed is trying to engineer what they call a soft landing, where they cool down inflation without triggering a recession. It's incredibly difficult to pull off, but so far, they're managing to keep the economy on track. One sector that's really worth watching right now is housing. Real estate has been in a weird place for the past couple of years. Home prices are still elevated in most markets, but sales have slowed way down because mortgage rates have been so high. If the Fed does manage to cut rates a bit more next year, we could see some life come back into the housing market. But there's also the risk that if the economy weakens, home prices could start declining, which would hurt homeowners but help first-time buyers. It's a complex situation with winners and losers depending on where you sit. Another area that deserves attention is the banking sector. Banks make money on the spread between what they pay for deposits and what they earn on loans. When the Fed cuts rates, that spread can get squeezed, especially if competition for deposits forces banks to keep paying relatively high rates to customers while their loan income falls. We've already seen some stress in regional banks, and this rate-cutting cycle could put additional pressure on their profit margins. On the flip side, lower rates could stimulate more lending activity, which would be good for banks in the long run. Let's talk about what this means for your investment strategy going forward. First off, if you're a long-term investor, don't panic. Yes, we saw a big drop in stock prices after the Fed announcement, but one day of volatility doesn't define your retirement. History shows that over long periods, stocks have always recovered from sell-offs and gone on to make new highs. The key is staying diversified and not making emotional decisions based on short-term market moves. If anything, pullbacks like this can create buying opportunities if you've got cash on the sidelines. That said, it's probably smart to reassess your portfolio in light of this new interest rate environment. Bonds are starting to look more attractive than they have in years. With yields in the 4 to 5% range on investment-grade bonds, you can actually earn a decent return with relatively low risk. That wasn't the case when rates were near zero. So if you've been heavily weighted towards stocks, it might make sense to rebalance and add some fixed income to your mix. Another thing to consider is international diversification. While the US market has been the star performer, other developed markets like Europe and Japan are dealing with their own economic situations, and their central banks are on different paths than the federal. Some emerging markets might also offer opportunities, especially if the dollar weakens as US rates come down. Having some international exposure can help smooth out the bumps in your portfolio. And here's something crucial that gets overlooked in all the market chaos and Fed watching. Your personal financial situation matters way more than what Jerome Powell says or what the stock market does on any given day. If you've got high-interest debt, paying that off should be your priority regardless of what the Fed does. If you don't have an emergency fund with 3 to 6 months of expenses, building that up should come before making speculative investments. If you're not contributing enough to get your full employer match in your retirement plan, you're leaving free money on the table. Looking ahead to 2025, we're probably in for a bumpy ride. The Fed is going to be data dependent, which means every jobs report, every inflation reading, every bit of economic news is going to move markets. Volatility is likely to remain elevated, especially as we get closer to the presidential inauguration and potential policy changes become clearer. But volatility also creates opportunities for disciplined investors who can look past the noise and focus on fundamentals. One thing that's become crystal clear from all this is that the era of free money is over. For years after the financial crisis, and then again during the pandemic, the Fed kept rates at or near zero, making borrowing incredibly cheap and pushing investors into riskier assets to find returns. That regime is done. We're in a new normal where interest rates actually matter again, where cash earns a return, where bonds are a legitimate part of a portfolio, and where stock valuations need to be justified by real earnings, not just hopes and dreams. This shift is going to have profound implications for how we think about investing and managing money. Younger investors who came of age in the era of zero rates and endless Fed support are learning that markets can go down as well as up. Companies that thrived on cheap debt are going to have to prove they can actually make money. Speculation is getting squeezed out of the market, which is probably healthy in the long run, even if it's painful in the short term. The bottom line is this: the Federal Reserve just delivered a wake-up call to markets that the easy ride is over. We're getting rate cuts, but they're going to be measured, cautious, and dependent on what the data shows. The economy is still in decent shape, but there are risks on both sides. Inflation could stay sticky and prevent more cuts. Or the job market could weaken faster than expected and force the Fed's hand. Either way, we're in for an interesting year ahead, and staying informed, staying diversified, and staying disciplined is more important than ever. So, what should you do with all this information? First, don't panic. Second, don't make drastic changes based on one day's market action or one Fed meeting. Third, take a clear-eyed look at your financial situation, your goals, and your risk tolerance. Make sure your portfolio is aligned with where you're trying to go, not just reacting to where the market has been. And finally, remember that this is a marathon, not a sprint. The Fed's actions today will ripple through the economy for months and years to come, and the investors who stay calm and focused on the long term are the ones who will ultimately win. The economic reset everyone's been talking about is happening right now, right before our eyes. The question is, are you positioned to take advantage of it? That's what you need to be thinking about as we head into this next phase of the economic cycle.